So good morning, everyone. Great to be here with you today. We're going to be just talking about your PPP funding that you may or may not have received and kind of what the next steps are. So here's what we're going to be covering today. Where did the money come from? How your loan amount was calculated? What the loan costs can be used for? So what are the eligible and allowable costs for the loan? And then how to best maximize your loan forgiveness. I know forgiveness is a big topic on everyone's minds now that the 8-week clock is ticking. So we're going to go ahead and get started. I think Don is back.
Good morning, everyone. Sorry for the technical difficulties there. Like anything that's been happening now the last 2 months, we sometimes don't know how everything's going to work out, and we have to kind of play it by the seat of our pants and fly with it a little bit. So thanks for bearing with me a little bit here. We're going to talk about a lot of great stuff today, guys. There's been a lot of things out there that have been happening to help practices continue to be successful in this COVID-19 environment. And, there's been even things happening today that we're going to talk about a little bit. You guys have seen funding come from a variety of different sources, okay? Some funding has come through the accelerated and advanced payment system through CMS. We haven't seen a lot of clients take on that. That was where Medicare was going to provide you with an advance payment. You were going to receive the money today, and then you were going to have to effectively work those dollars off. So beginning sometime in August, when you started to see patients, that's when you were going to earn the money that you were receiving today. So it was an advance payment. Come August, they were going to recoup the dollars. And then later in the year, sometime in November, if they didn't recoup all of those dollars, it was going to become a loan and you were going to have to pay that back, okay? So that was going to be a loan at 10.25%, okay? So we didn't really see a lot of clients do that. Another source of money that came through the CARES Act was the Provider Relief Fund, the HHS stimulus package. There were 2 rounds of funding. This was the money that many of you received in April 10th or April 17th. And so we're going to talk just briefly about that, but the main focus of our program is going to be on the SBA funding, the PPP funding that I suspect the bulk of you on this call received. Right now I can see we've got 155 people on the call right now. So we're going to talk a lot about the forgiveness of that. So Samantha, if you could help me right now, I'm not able to advance the slides for some reason.
Yeah, absolutely, Don. We got you covered.
Thank you very much. Appreciate that. So let me get to this. Guys, here's a timeline of what we're looking at in terms of the funding that we all received. So on March 13th, boy, it seems like a lifetime ago, the pandemic was declared, okay? Just 2 weeks later, the CARES Act, and that's a lot of, this is where the act, that's the act where a lot of this funding really came from, was the CARES Act. So that was about a month and a half ago that act was signed. That authorized the PPP program, okay? So this program began accepting applications on April 3rd. And, that was kind of a dead sprint, it seemed, for many accountants and many businesses to try to get their application in. You'll remember, I think it was, Danielle, what was it, $349 billion or so that was allocated to this program right there. And the vast majority of you probably applied during that application window, okay? Then on April 10th, the first round of the HHS stimulus, we've been calling it, that was the Provider Relief Fund that kind of just magically appeared in many of your bank accounts on that Friday. I know we received a number of calls from clients letting us know, hey, we got a significant amount of money ACH'd into our account called HHS stimulus. What does that mean? How did that come through? Okay, so that was kind of one of the tranches of funding came through there. April 16th, that was kind of a scary day for a lot of people. That was when the first round of the PPP funding was completely spoken for, okay? So a lot of us were having discussions with our clients who were unable to get into that first round of funding. They felt kind of defeated right there. A variety of reasons why that happened. Many banks were pivoting much more quickly and getting those applications in. Those bankers that were able to do that, those clients that were able to do that, actually saw their funding come in a little bit quicker. So they were at least pretty pleased that they got their money in. April 17th was another Friday that the continued first round of HHS stimulus deposits came in. Okay, so that kind of ended round 1 of that. And from there until now, people have been attesting to the receipt of those monies. So if you haven't gone through the process of going onto their website and attesting for the receipt of those monies, if you want to keep those monies, you have to go through and you have to attest certain terms and conditions. You have to read through them. You'll want to do that. You'll want to contact your Raymond advisor and gain an understanding of what the types of things that you are attesting to, and to go through that attesting phase that has to be handled there. Then on April 24th, they actually released guidance on how to calculate the PPP loans. So guys, this thing was really a ready, fire, aim approach in many aspects, as the federal government got this money out very quickly. And I know to a lot of people out there, when these types of situations occur, it's a little frustrating. Kind of like frustrating when your Zoom meeting doesn't work when you've got a lot of people waiting to talk to you. And so there was a lot of concern about the rules changing through the game. Danielle and I are going to talk a little bit about that. Got to recognize, guys, that the rules continue to change. Nothing's really staying the same with this. There's been some things happen even today that have hit us a little bit more. April 26th, that a Medicare advanced payment program that I talked about earlier from CMS, that was suspended. Didn't really have a lot of clients take advantage of that. Probably had clients that I deal with, probably just 3 or 4 of you took advantage of it. You know, it was really going to cause a hardship upon your billing office, your CBO, perhaps your outsourced biller to kind of manage that. And it was really going to cause the potential to cause some frustrations in cash flow. Not to mention, like I said earlier, it would turn into a 10.25% interest rate loan at the end if you were unable to fully recoup those monies, meaning work them off. Okay, so they suspended that program. Good news regarding the PPP program is that the funding reopened on April 27th. So that was kind of the next tranche of money that came into there. And so for those of you who weren't able to get through on the first tranche of money, I think pretty much all of you who wanted to were able to get through on the second funding of money. And I use the word who wanted to, because I did have a few clients that for whatever reason, they decided that they didn't want to do this. They didn't want to take advantage of those fundings. Interesting point, just today, I mentioned earlier about the HHS stimulus package. Very interesting point happened today is that phase 2, when you attested for phase 1, you had to apply for phase 2. Those of you who know about this thing, there was $30 billion allocated in phase 1. Phase 2 was an additional $20 billion, bringing up the total allocation to $50 billion. But phase 2 was kind of meant to bring in some people who were not included in phase 1. Phase 1 was largely based upon 2019 relative Medicare payments. So those that are heavy providers of service to Medicare patients, they saw a good chunk of money. Those that don't do much Medicare work at all, let's say pediatricians, other than maybe some kidney cases, might not bill Medicare. OB-GYNs really don't bill Medicare all that much. You might have pediatric hospitals that don't bill Medicare at all. So those types of clients really didn't see any substantive monies from phase 1. So phase 2 was kind of meant to level that off a little bit. It took into account your 2018 total income without regard to where it came from. There were a lot of people concerned that they could see a take back of their first payment. So you had 2 payments there. They were concerned they were going to see a take back of that. And so far, I haven't seen that. Danielle and I were talking a little bit before the presentation today that we hadn't seen any of those takebacks. In fact, I was seeing 7 to 8% payments as a percentage of what you received in your round 1 or phase 1 stimulus check right there. Danielle had mentioned that Danielle, what was it, 25%? I think you said you heard?
Yeah, I had a client that got about 25% of their original deposit from round 1, which really means that the Medicare billing might not have been as high for this client, but their total revenue in total to all of the healthcare providers was a little bit higher. So they got a larger second round.
So guys, if you go into your bank accounts right now, some of you might be checking it to say, I wonder if I got that ACH'd into my account. You know, we said there were a few clients that we've noted who've received it so far today. Not everyone has. So if you've attested to phase 1, applied for phase 2, I think probably we're just going to have to remain a little patient. PPP application window is going to close actually at the end of June. So, we've got some time. For those of you who have not applied for whatever reason, we've got some time. Interesting stats here on the right-hand side of the slide give you an idea as far as the number of loans that were distributed here. These are SBA stats. You can see a little over 183,000 went to the healthcare industry, $40 billion in round one, and the healthcare industry made up 12% of this. So, you look at the math here in terms of how many, the sheer volume of the loans here, and we're going to talk a little bit about the settlement process that's going to occur. I think it's going to make you a little bit dizzy when you start to think about the volume of the loans that they're going to have to do. Those of you who were working with your bankers and getting these applications done, which all of us were, we heard horror stories of bankers working, 12, 13, 15, 18-hour days to process these applications. We're going to see a compression of the window in terms of the settlement of these applications. So you throw that into the pressure cooker that's already out there with people restarting their practices, and you throw people being sheltered in place for 2 months, people not being able to, working in their practices, bringing back staff who are maybe on unemployment, perhaps making more money. Now you're bringing them back to work in an uncertain environment. And we're going to talk about the compression in the timeline for the forgiveness of these loans, guys. It's going to make this summer quite the doozy here. And, we're going to get into that, Danielle, so I'll turn it over to you.
Yeah, a couple more things before we move on that I wanted to touch base on the stimulus program. So originally you had 30 days to attest to the funds. They extended that to 45 days. So we're still kind of in that attestation window for the first round. If you don't go on and attest, you are deemed to have attested. So by doing nothing, you are attesting to those funds. So if you plan to return them, you want to make sure you do that within that 45-day window. The HHS has a website, provider relief website, strictly with all the information, the portals. So that's where you're going to go out and be able to do all of that attestation and application for round two.
Good point.
Round two also is not first come, first serve. So it's not like the PPP where when it runs out, it runs out. So you still have time to do that. So if you have not applied for round two, every week on Wednesday, the HHS validates applications and goes through and sees who has applied. So you can still go and do round two. So now moving on to the PPP.
Hey, Danielle, if I could, we're starting to see some activity in the chat room right here. Just want to let everyone know, I didn't hear it since I didn't have my ability to hear at the start of this thing. Sam probably mentioned it, that Danielle and I and your Raymond advisor are going to do the best to get back with you on these questions. So if we don't reply to your question here during the presentation, know that we will get back in touch with you. We're not going to forget about your questions.
Great, thanks, Don. So the PPP loan, here's the initial process of the loan. So the calculation of the loan, how did they determine how much you could borrow? So you were able to borrow up to 2.5 times your average monthly payroll cost, up to $10 million. So no loans more than $10 million. And generally speaking, there's always exceptions to the rules. It's any business and some nonprofits with less than 500 employees, generally. So what are the payroll costs that you could include and what time period? Really depended on your bank. So some banks were allowing you to use your most recent 12 months ending in March, and some used calendar year 2019. So based on your lending institution's rules, that's kind of the time period that you would use. And the payroll would include your wages, your health insurance, your group health insurance, retirement benefits, state unemployment, and there are some costs in payroll that are excluded, which we'll talk about. It also does not include independent contractors. I know early on, some of the application processes said to include your 1099 contractors that you paid, but then they went back and said, well, 1099 contractors can file for their own PPP loan, so you could not include them when you were calculating your cost. You also could not include any salaries over $100,000 per person when calculating your average monthly payroll, so you had to kind of set that aside, and that was not included. If you had any COVID Family Medical Leave Act payments, those were also excluded from that. There was some different rules for self-employed individuals that file as a Schedule C that came out a little bit later, and they also weren't allowed to apply right away. So for self-employed Schedule C individuals, if you had no employees, it was truly your net profit from your Schedule C capped at $100,000 per year. divided by the 12 months for your average, and then multiplied by 2.5. If you had employees, you could take your net profit plus the wages, health insurance, and retirement benefits of those employees. You could not include, as a self-employed individual, your health insurance or retirement benefits. It was just your employees. Also, the bank's role. So it is a SBA loan. It's 100% backed by the SBA, but it was administered through lending institutions. So most banks only worked with their current clients. So if you were a current client, you could work with your own bank, but they weren't accepting anyone to come in if they didn't have a current lending relationship. Some banks were allowing, but it was really few and far between on those. And then the forgiveness process is really what we're going to talk about the most today. So just a couple highlights, and we'll get into the details in a little bit. The forgiveness period starts 8 weeks as soon as you receive the fund. So as soon as the funds are deposited in your account, your clock starts for 8 weeks. The forgiveness process is likely going to be handled by your bank. They're going to be the ones that tell you what documentation you need, what the process is. They'll probably have tools and calculators for you to use. But as we'll talk about a lot today, we're still waiting for further guidance. So we're still waiting for the SBA to come out and give us a lot of clarification. So today we'll talk about what we know today, kind of where some gray lines are, and then we might just say we don't know and we're waiting for further guidance, but we expect that guidance hopefully soon here. And also the first 6 months of payment. So whatever is not forgiven turns into a loan. And we'll talk about that a little bit later, but there's no payments for 6 months. So once you determine what's not forgiven, you have 6 months to make payments, and the interest at 1% for 2 years once we determine that amount. So what was the intent of the PPP loan? I think it's all in the name. So it's called the Paycheck Protection Program. The overarching intent of the act is to pay your employees, keep them on payroll, keep them off unemployment, and to provide a little bit extra for your rent, utilities, and some other allowable costs. But the main intent of the act is to pay your employees. The forgiveness, yeah.
It's kind of interesting to think about that. I completely agree with you. When you look at this, the intent's to, seed businesses back during the startup phase, right? And we've all been having the experience, I'm sure many of you who are on this call, who live in a state that went into a shelter in place. We've got people on the call from Ohio, Florida, Michigan. Each state has been handling things a little bit differently. But one of the difficult things here really is, how do business owners use these dollars effectively in a shelter in place environment where, say, like in Michigan, where the governor has effectively shut down many of our clients, with the exception of certain specified emergency type cases. How can people use this? This is a real fascinating question, guys. I'm not saying we have the answers. I just received a communication today earlier from a client indicating that he had read from one of his professional societies that they're looking at maybe liberalizing some of these rules. And Danielle and I were talking about this prior to the presentation. We wouldn't be surprised. Now, we're not saying this has happened, but we wouldn't be surprised if the 8-week window has lightened up a bit. Okay, we wouldn't be surprised if maybe some of the rules we're talking about might change a little bit. It was interesting. Danielle prefaced everything by saying these are the rules we know of as of today, guys. It's really an ever-changing environment. The landscape's changing. We need to be working together to make sure we understand the rules as they change. Kind of stinks. It's kind of hard, but that's really what it is. So.
Mm-hmm. And then the forgiveness rules, and we'll get into this. This is really the main point of the presentation today, but it's meant to provide guidelines for how to use these funds and the acceptable uses. And then anything above and beyond that is really just not going to be forgiven and will turn into a loan. But we're going to go into all that in just a moment here. So what are the allowable costs? What can you use your PPP funds for? There's a handful of items. The main one is payroll costs. And Don will get into that next here because it means more than just payroll. Facility lease, your rent agreement, as long as your rent lease agreement was in place before February 15th, it's going to be important to make sure you have a copy of your lease agreement on hand because you might need that for your forgiveness documentation. So any rent payments made in this 8-week period, and we'll talk more about what that means later. So I don't want to say any rent payments, but we'll get into that a little bit. And then utility payments, including electric, natural gas, water, phone, fax. The AICPA, which is the American Institute of Certified Public Accountants, has some FAQs out there, and they've added some additional utility cost here. And some of those are garbage, security monitoring. Again, we don't know exactly what the SBA intends to include in that utility cost. We expect with their further guidance that they might add or remove some of what people think is included. But right now, it's important to just keep track of what you're spending your money on in the utility space. And if we can add more cost once the guidance comes out, we'll be able to add those. And then interest on other pre-existing debt. It's important to note that you are allowed to use your PPP funds for this, but they are not included in the forgiveness. So while your interest on your covered mortgage would be included in the forgivable portion, interest on other debts are not. So while you use these funds, keep in mind that that will automatically be part of your non-forgiven portion.
You know, Danielle, a few interesting things. That last one you mentioned about using interest on pre-existing debt, that one's just going to cause so much confusion, I think, because you can use the money to pay for that, but it's not a forgivable cost. It just strikes me as being a very difficult one. Those of you listening here, discuss it with your advisor, but that one's one to be very cautious of using your money there. And also the facility lease, the rent costs right there. Danielle mentioned having a copy of your lease agreement. You know, many of you have a separate entity. You own your practice, you own your facility in a separate LLC. And, you know, sometimes we have lease agreements. Sometimes we might not have lease agreements. Sometimes we might not be able to find those. Sometimes the amount of rent or lease that we pay, isn't really documented. Maybe we've changed it over the years, and it really hasn't been a huge issue for many reasons because you own both of them. It's just kind of money out of your right pocket, putting it into your left pocket in a lot of ways. And we haven't wanted to go get a lease agreement in place and incur all the costs of doing that. But in this situation, we really do need to have that lease agreement, right, Danielle? I think that we're going to be in a world of hurt going through settlement. So probably the next takeaway from this is making sure you got that lease agreement. I don't know, leave it out on your desk a bit, let it get sun aged a little bit so it looks like it's been around, but make sure you got it and that it's in place because it's going to be really important in the forgiveness process, right?
Yeah, absolutely.
So Danielle mentioned here payroll costs, okay? And we're going to talk and provide some further definition and further clarity around what this payroll cost is meant to include, okay? And she mentioned earlier that we have wages, salaries, and we have this $100,000 rule. So many of you within this practice, if your physicians, your dentists will earn over $100,000 annually, okay? So if you do, you cannot charge any amount that exceeds that $100,000. Now remember, we're only in this for 8 weeks. So basically you take 52 or 100,000 divided by 52. That gives you the weekly salary that you're able to allocate to this grant or charge to the grant. So when we're working on the forgiveness period here in a few weeks, this is a rule that's going to come into play again. It came into play when we did the loans and we did the application process too, because we had to take out the amount of your compensation in excess of $100,000. So it's the same way in, it's the same way out. We've been getting a lot of questions here on these next few things, vacation pay, sick pay, parental leave, family medical leave pay, to the extent that they are paid through the normal payroll process, and it has been something you've been doing. I also think maybe the Families First Act, Danielle, I don't know, I'm not an attorney, so I'm not 100% sure, but I think under that act, you can charge that to this grant.
As long as you don't receive a credit for that.
Thank you.
So if you receive a credit, then they are excluded cost.
Good point, Danielle. COVID-19 hazard pay. Probably a number of you on this line have considered doing this, paying your staff a little bit more. Is it fair? Is it reasonable to do this? We've had a lot of dialogue internally on this matter. We think that, yes, it is something that can be done, but it has to be fair. It has to be reasonable. You can't say, boy, I'm paying my hourly staff $15 an hour more as a COVID hazard pay. Is that probably going to work? I think in a lot of ways, your banker is probably going to be the first screen that you need to get through on this. And so if it's $1, $2 extra an hour, I think that's probably going to be okay. Note I said probably, but anything in excess of that, you probably are taking an aggressive position, and maybe we should talk about that position to see where we land, because when we're in the forgiveness period, we might find those costs being deemed ineligible for forgiveness. Group health insurance. Important thing to note here is that those practices that do provide health, dental, and vision coverages for the next 8 weeks, so basically 2 bills, okay, those are going to be inclusive. You can apply those to the forgiveness against this loan, okay? But it's important that you know that that is net of any employee contribution. So you know how out of your pay, your staff might kick in, a couple $100 towards their health insurance, okay? The amount that you can charge is what the company pays, not what the employee pays. Going back up to the wages and salaries, it's the gross pay that you pay an employee. So if you're paying them $15 an hour and they work 40 hours a week, it's $600, okay? It's not what they net to. When they gross 600 and they net to 420, it's not 420 that you're applying against the grant, it's the full 600. So if the employee's paying something towards their health care, you're effectively being reimbursed for that through their wage. So it's the company's net contribution there, net of the employee contribution, that we need to take a look at. Next item is the retirement plan contribution. Guys, this is a really important one. The vast majority of you have a qualified plan in your practice, be it a 401k profit sharing plan, a cash balance plan, a SEP plan. You have some sort of qualified plan that you're putting away money on a pre-tax basis. Good news is that contribution, you can use some of these monies to fund that contribution, okay? Bad news is we don't exactly know how this is going to work. Here's what we think right now. This kind of sounds reasonable to many of us. If you take a look at your 2019 contribution, divide it by 52 and multiply it by 8, that's probably getting you close to where you would need to be with this, okay? So that's probably a reasonable contribution to put in. I've noted in talking with some TPAs, some third-party administrators, that they're thinking they may have to run some calculations on that to see if it's reasonable. It's going to be a difficult thing to know, because most of your TPAs might do some preliminary work in, say, November, December, based upon estimated year-end wages. Who really knows what's going to happen at the end of this year? Well, we're going to have to see how that works. I personally think the 852 is probably going to work well. Payroll costs also include your state unemployment taxes that you might pay. I think that's on the first $9,500 here in the state of Michigan. I'm not sure what it is in other states. That's nice, but here we sit, in the end of the second quarter, beginning of the third in many instances here, when this 8-week period will end, and will they have already hit their state unemployment cap? In many instances, they may have hit that cap during Q1. So there's probably not a lot of reimbursement to be had there. Remember, state unemployment in Michigan, probably similar in other states, is on the first $9,500. Here's an important one. I get this question quite a bit from clients when they're looking at this: is payroll costs, what they exclude. Notice we've highlighted that. So on your 941, when you're making your 941 payment, you have employer's Social Security and employer's Medicare tax. You know, the matching contribution that you have to make, the amount that's withheld, you have to match the amount that's withheld from your employees. That is excluded from being a reimbursable or a forgivable cost under this program, okay? I get that question quite a bit. Can I just pay my 941 with this? Some of it, but not all of it, okay? And then federal unemployment here, it's a much smaller amount than what state unemployment is, but that's another area that that you cannot, take any deduction for. So you got to be aware of that. Danielle, any other thoughts on this at all?
No, I think you covered it pretty well on there.
Okay. Everyone, we're going to get into the meat of the subject right here, which is the forgiveness aspects of the PPP loan. And there's quite a bit here that you need to be aware of here and how we're going to work through this process. One of my fellow partners, Kurt Nurnberg, kind of said it right to me the other day. We were talking about this, and he said, there's a lot of clients out there that think they're going to get 100% loan forgiveness on this. And he said, in looking through all this and beginning to understand this, I think we need to begin to adjust expectations here. Adjusting expectations here is something that's pretty difficult to accept with this, but I agree with what Kurt had said here. There is some aspects of this where I think you should probably not expect to get fully forgiven on this. To get fully forgiven on this, you need to expend the money, the loan proceeds, within 8 weeks of the loan origination date. So guys, that's the date the money hits your bank account. That's when the clock starts to tick. Get a lot of questions on that one to say, when do I have to start to spend it by? Is it when the banker called me and said, hey, congrats, you got the money? No, it's when the money hits your account. You need to spend it on eligible/forgivable and incurred costs. Okay, that's what Danielle and I talked a little bit about, well, not a little bit, about earlier, the rent, the wages, the utilities, those types of things. 75% of the proceeds must be spent on payroll costs. So as the rule stands right now, of the forgivable amount, 75% must be spent on that. We're going to talk a little bit about that in a minute. Then you get to an area of these rules that are kind of something that maybe you haven't heard too much on. There's 2 reduction calculation tests that we're going to go through right here that are pretty important. And they're kind of laborious in what you have to do to comply with these tests. And I don't think we're going to be able to skate around these things. I think your banker is going to want them. And those of you who received over $2 million as a PPP loan, and there are some of you on the call who did receive over $2 million, the SBA came out and saying that they will be looking probably most at those ones over $2 million. So you'll want to make sure that you have, all your ducks in a row and everything tied out really well with this. So, okay, Danielle, any thoughts on this one for you?
No, I think we're going to go into those reduction rules a lot here, and this is going to be important when kind of putting together your documentation for forgiveness and making sure, as you mentioned, setting those expectations that if you know when you're going through these rules that you don't meet all of these tests 100%, all of your loan will not be forgiven. So setting those expectations now.
Hey, some important foundational things to know here, and this one's getting a lot of discussion and a lot of confusion. Right now, in order for these to be forgiven, they must be incurred and paid. Okay, this is a real difficult concept here, I think, between the 2 of them, because they're kind of mixing together 2 bases of accounting. Accrual basis of accounting is when you incur an expense. Okay, cash basis is you recognize an expense when you pay it. So what the plain language of the law says is that it has to be incurred and paid. Okay, so during this act, incurring a rent bill and paying a rent bill, let's say for the month of May and then the month of June, it's pretty easy. I've had some clients say, hey, I never paid my March bill. Can I use my money here to pay my March bill? I don't necessarily know if the bank's going to care what month internally you apply it to. You can just tell them, hey, I've made 2 months worth of rent payment in 8 weeks. That seems reasonable to me. Okay. But let's talk about payroll. Many of you will have a payroll process where you pay biweekly, say on a Thursday for time ending the prior Friday. So you incur time through the prior Friday and you pay it the following Thursday. So let's say that your 8-week window ends on a Friday, that a payroll period ends, and then you pay the following Thursday. Does that mean that you have to do kind of a quick payroll, an unscheduled payroll there to pay those amounts to make sure you're within this 8-week window of being incurred and paid? I kind of think it does right now. Okay, so be prepared to perhaps do a payroll on the fly at the end of this 8 weeks. Okay, so you may have employees that are paid, they'll be paid within 1 week of another. In my example right there, be prepared for this. Tracking of funds, guys, this is going to be of ultimate importance right here. Tracking in a separate bank account is something that we've recommended to a lot of our smaller clients that might not have a sophisticated internal accounting system. And this helps to make sure that you're using the money on allowable items. Okay, so tracking those funds, when you pay a utility bill, copy that utility bill, put it in a file. When you pay a rent bill, copy the rent bill, put it along with the rental agreement. When you have a payroll, print out the payroll register for that week, put it in your file. Let's make this settlement process easier for us. 75% rule, I touched upon it earlier. This is an important aspect here. The forgivable payroll cost must be at least 75% of your total costs. The 25% can be used for rent or utilities. Guys, that's a 3-to-1 ratio that we're going to need to maintain, okay? I've been talking with a lot of you, and there's some of you who have been having some issues. Hey, we're not bringing staff back. We're a little bit concerned about using 75% of our money for the total payroll here. that's telling us that you're probably going to have some of these monies that are not forgivable, some of these monies that are going to have to be paid back. And if you're having this type of an issue, you're likely having a problem with some of these reduction rules that we're about to touch on here in a moment, okay? So we're going to touch on the two reduction-based rules here that I think are really important for you guys to be aware of. First one relates to a reduction in the number of employees. The second one relates to a reduction related to the salaries and wages that you pay to your employees. It's an important thing to note here, guys, that these tests are separate and distinct from one another. While they both take a look at your employees and your salaries and wages paid, there really isn't any interplay within them that allows you to offset some of the costs, offset one with the other, okay? So make sure you're aware that these things are separate and distinct tests, okay? So when we go through, when you're working with your Raymond advisor sometime in the July timeframe regarding this settlement, you're working with your banker, you're gonna hear them say, hey, these are two separate tests. There's no interplay. And they're reduction calculations, everyone. They are going to reduce the amount of the loan that you're able to be forgiven on, okay? First one relates to a reduction in the number of employees, okay? Guys, we're not gonna sit here and read to you, pages of the act. What we're gonna do here is really kind of boil it down as to how it works, okay? And when we look at this, here is really how the functionality of how it works here. You're gonna go through and you're gonna determine an average full-time equivalent calculation, okay? So this is gonna require some spreadsheets, guys. Get Microsoft Excel started with this, get your spreadsheet. Don't do this by hand. Make sure you've got a computerized spreadsheet that you're tracking this on, okay? What you're going to need to do here is you're gonna need to determine the average weekly number of full-time equivalents that you've employed for the 8-week forgiveness period, okay? We've had some clients say to us, I'm going to leave my staff on unemployment for 7 weeks, bring them back in the 8th week, and I'll pay them 8 weeks worth of salary at the end, and that's the way I'll use it. Isn't going to work. You've got to go through and determine the average number of weekly FTEs. Then you're going to determine the average number of FTEs in a prior period, a look-back period, okay? You're going to have to calculate full-time FTEs. We think those are people that are going to be working more than 30 hours a week. That's what it was under the applicable large employer standards of Obamacare, okay? And then you're going to have to adjust the part-timers to get them up to be a full-time equivalent, okay? There's no extra credit for those of you that work 60 hours a week. You're not going to get 2, okay? And the prior periods that you're going to have to take a look at are February 15, 2019 to June 30, 2019. It's kind of a weird period right there, guys. It's a 4.5-month period. I don't know exactly why they chose that. I think it had to do with seasonal businesses. This is stated in the act. And then you're going to look at the 2 months ended February 29th, okay? What you're going to do is you're going to create a fraction. You're going to take a look at what your average FTEs are for the 8 weeks, and then you'll evaluate that average FTEs under either one of those prior periods, okay? And you'll want to choose the one that gives you the largest percentage, okay? We're going to kind of bring this together at the end, guys, a little bit, and we're going to show you the math as to how this all works. I know you guys will want to see the math as to how this works. Danielle is going to talk about that in a minute, but you'll want to use the largest percentage. So when looking at this thing, don't just say, I'm going to look at the one from January 2020 to February. That might not be your best. You're going to need to pull the payroll records to take a look at the period in 2019 as well. So let's use an example right here with it and take a look to see how it actually works. Okay, so baseline, a company receives $1 million PPP loan, and during the 8-week period, they average 42 full-time workers. Okay, so they got 42 full-times, and let's say they have 16 part-time workers, all working 15 hours a week. Guys, let's make the math easy here. Okay, so that's 50 full-time equivalents here. Okay, so we've gone through and we've looked at the 2 look-back periods. And for the 2019, we've determined that we had 60 full-time equivalents. For 2020, hey, we were doing well. The economy was pumping. Our business was doing well. We had 62. Okay, So now we're looking at creating a fraction here. And I'm not going to make you divide by a fraction, multiply by the inverse. We're not going to go back to 6th grade math here. We're going to keep this easy. And we're going to determine a percentage here. So you take a look at the math right there, and you'll see that the option of 50/60ths, 5/6, which is 83.33%, that's the better of the two options. Guys, you can read this to be exactly what it is. If you have $1 million loan, and this one comes to a forgiveness of 83.33%, that means that after this first reduction calc, your forgivable loan is $833,333. Okay? So there's a lot of work that needs to go into calculating what I just laid off here in about 4 steps, but there's a lot of detail in determining step number 2 in this entire analysis here that you're going to need to take a look at. Now we're going to go on to the next step, and Danielle, I'll turn it over to you.
All right. So we went through the first test. So now we're going to go through the second test. And this test is a reduction relating to salary and wages. This is going to be an employee by employee test, and it's going to be a dollar for dollar reduction. So not a percentage, but a dollar for dollar per employee. So your forgivable amount is further reduced by any drop in compensation for an employee that exceeds 25% as compared to their last full quarter worked. So if you have an employee that worked in the 4th quarter and earned $20,000, if they don't make at least 75% of that in the 8-week period, we're going to go through an example, so we'll lay it all out. Whatever that difference is, there's a dollar for dollar reduction in your forgiveness. So like I said, it's calculated on an employee by employee basis. It includes those employees who worked during the 8-week coverage period and the last full quarter. There are some exclusions. So you can exclude anyone that makes over $100,000. So if they made $100,000 prorated on an annual basis last year, you do not have to include them in this test. The other one is those who refuse to return to work. And this is a big one that the SBA just released an FAQ about. If you recall them to work, and you need to do this written, give them a written notice of recall, and they say no, and you document that, that is not going to penalize you on the forgiveness piece if they don't come back. So you need to make sure that you have written documentation, their denial of coming back is written, and that you can prove it, and then you are not going to be penalized for that. The other question that we have out there right now that we don't have a specific answer for is, what about those who left employment, either retired, were terminated, maybe they were there last year, but they left before? We're going to wait further guidance on that one to see kind of how that plays out, but that's kind of an open question at this time. So we're going to go through an example here. So I'll just tell you briefly. You're going to look at their last quarter worked, and you're going to equate it to an 8-week comparable. So we've heard 8 out of 13 week. So quarter's 13 weeks. You take an 8 out of 13th proration and then apply that to the 75% test. So let's go to the example. So here are our 6 employees, and you do this on an employee by employee basis. So you look at what they made in, so this example, we use Q1. What is 8/13 of that wage? So for Kip, he made $12,500. 8/13 of that wage is $76.92. He needs to make at least 75% in this 8-week period, or else whatever that differential is will not be forgiven. So for Kip here, his 75% requirement is $5,700. In the 8-week period, we paid him $5,100. He has a reduction of the forgiveness of $635. So on an employee by employee basis, you track what you paid them, what they made in the comparable period, and that's a dollar for dollar reduction. If you paid someone more, you don't get to add that back, so that's not a benefit. So it's just, we're just sum up the 4 people that were under. So now we have a $3,300 reduction in our forgivable calculation here. So that's step 2, rule 2. So we're going to kind of pull it all together because, as Don mentioned, they are separate but distinct tests. So it's not one or the other. It's not whichever one's higher. It's both. So back to our last fact pattern of a company that got $1 million PPP loan. If in the 8-week period they spent $900,000, our first test, we came up with 83.33% on the FTE calculation. And then step 2, we came up with a $3,300 wage reduction. We're going to apply both of those to reduce our forgiveness. So on the first calculation, we've got our $900,000 of allowable costs. We multiply that by our FTE reduction. So we're down to $750,000 of forgivable costs. Then we have to reduce it further on the dollar for dollar reduction. So now we're down to 746. So of the $1 million loan received, $746,000 is forgivable.
So
Now
Danielle,
yep.
I'm sorry. I think this is an extremely important slide for everyone listening in on to understand how the math works here. This really kind of boils it down here. You can see, in the example I gave, I assume the $1 million costs were all forgivable. In this example right here, you might not have incurred $1 million worth of forgivable costs. We're saying you've only incurred 900 here. So you can see how this math works out, and that you've received $1 million, but they're only going to forgive the 746,641. So you've got a delta there of 253,000 and some change, which for this example is not forgivable. So that's the important point that I think everyone needs to take away from this discussion, right?
Exactly. The last thing I want to add, and we, again, don't know how this is going to come to play, but in the act itself and in some of the information sheets, there is a June 30th kind of get out of jail free card, where if you've restored your levels to full time and matched your levels of your calculation by June 30th, you're not penalized. So a lot of people thought, well, if I'm back and I'm fully practicing by June 30th, I'll have no problem meeting these rules. But what we don't know is on the dollar for dollar reduction, it says that you would have restored the salary levels by June 30th. Does that mean you have to pay them the difference to get that forgiven? Does it mean as long as they're back to full time and making what they made in the prior year, or is it okay? We don't know. So it's better to be conservative and set your expectations on the low end, but that is out there, but we just don't know how it's going to interplay yet. So I'm going to hand it back to Don here.
Okay. Can you hear me okay, Danielle?
Mm-hmm.
Okay. So guys, some of the things we think you need to do right now is things you need to know right now. I mentioned earlier about making an Excel spreadsheet. You need to jump on this, everyone. You need to get ahead of this. No one's going to want to do this in the month of July. We're all going to be sick and tired of spending, nights in our basement or days at home, telemedicine, not seeing patients, whatever it is. You're not going to want to do this administrative stuff. So this is maybe a good project to have your staff do right now. If they're not really working too much seeing patients, maybe you have them begin to accumulate the spreadsheet that we talked about here, taking a look at the hours worked, their name, hours worked, wages earned during each pay period during these applicable time periods. Guys, we are in the 8-week period right now. For most of you, if you've taken the loan, if you've received the loan, I guess there could be some of you who haven't received the loan yet. So get on this, start to get this information put together. Prepare for the forgiveness process. I mentioned earlier, track the usage of the funds. Okay, this process is going to take longer than you think. I think we should all become aware of that. Here's a doozy. The CARES Act says that you have 21 days after your 8-week period ends to submit all the information to your banker. Guys, that means that when we started this thing, we had 8 weeks. Now we got 3 more. That's 11 weeks to get out of this thing. That's going to put us smack dab in July. Many of us might not be really wanting to do that during that time of the year. Let's make it easier for all of us. While the SBA will make the ultimate determination on this, I think your banker is going to be instrumental in this process. I really think they're going to be the first screen here that the SBA is going to look for to make sure that you're not using these funds inappropriately. So this is not money that you can buy a boat with, buy a new car with, or anything like that. These funds have to be used for the intended purpose right here. And again, just to point this issue out, have your documentation in order. The more documentation, the better. So, Danielle?
Also, reach out to your Raymond advisor. If we've been helping you with this process, we're more than happy to share some spreadsheets we have to help you work through this, to kind of help you through this whole process. So just wanted to throw that out there.
Good.
The other thing is this SBA loan review. I'm sure a lot of you have seen in the media the last few weeks some horror stories, some pictures of people behind bars kind of saying, did you really need this money? Did you certify that you had economic uncertainties? Some of the larger chains ended up paying it back. They added some new FAQs about who should take these funds. And just 2 days ago, the SBA came out and said that if your loan is under $2 million, you will have been deemed to have met the current economic uncertainty to take this loan. So they're saying, most people that got these loans that are under $2 million needed them. We understand that they're not going to have to kind of prove anything further. If your loan is over $2 million, they might be asking some questions, wanting some documentation, some facts and circumstances of why you took the loan. So just some facts to consider, elective surgeries were canceled, your patient volumes were down, just making sure to have some of that documentation and those fact patterns if your loan was over $2 million to show kind of why you needed the loan and what you used it for. They might ask the following questions. Was your loan necessary to support ongoing operations? Has the present economic uncertainty affected your current activity? I think all of us, especially in the healthcare field, can say yes. You couldn't do your surgeries, your volumes were down, your patient visits were limited. So just having that information kind of ready, while it's fresh in your mind now, because in 8 weeks or 21 days after the 8 weeks when you're going through this process or when your loan is reviewed, it might be, who knows, it might be kind of farther out of your mind. So kind of getting that hammered out right now. And then what happens to the portion of the loan that's not forgiven? We talked a lot about how to get the forgiveness, what the formulas are for reducing forgiveness. But after you go through all of that and you determine what your unforgivable portion is, it converts to a 1% 24-month loan. It has 6 months of payment deferrals and no prepayment penalties. There's nothing to say at the end of this when you calculate your forgiveness and you've got, say, $50,000 left over that's not forgiven. You can give that back right away. You don't have to keep it as a loan, but you can. And then beyond the 8-week period, these costs should continue to be used for payroll and allowable costs after the 8-week coverage period.
Danielle, it's interesting. I received a communication from one of our clients who was reading through some stuff from his national society, and it intimated that there's some discussion at Washington regarding moving away from the 75% rule that we talked about earlier, spending that on payroll, and that the 8-week period for forgiveness here will be extended to 24 weeks, and that the repayment of this loan could go from being 2 years to 5 years. So this goes to speak to the ever-changing landscape on this entire act right here, guys. There are so many different things that you need to be kept aware of with this act. We appreciate the time that you spent with us. Sam, are there any questions that you think we should go over? I see some questions coming through in the chat line. Don't know if we have a whole bunch of time. I mentioned earlier we will get back with you. Anything to kind of finish up with in terms of questions?
Don, Danielle, thank you so much for today. This presentation was wonderful. You actually, we did have quite a few questions come through. Ideally, a lot of them were covered by the slides themselves. So just as a reminder, the slide deck, the recording, everything will be made available following the presentation today via email, via our webpage. You can see the link on your screen currently. It'll take you right to our COVID Knowledge Center. You'll see some good information. You see the healthcare practice right here. So more to come, as always. We do have a couple of quick questions, just using the time, a minute or two we have here. So a lot of it was covering the associate or the employee side of things. And it said, what if we offer employees the opportunity to come back and they do not return? Does that affect our PPP forgiveness? Will we have any impact there if they don't return on their own merit?
Yeah, I think we covered that a little bit in the slides, but just to reiterate, there is an FAQ out by the SBA that if you have a written notice of recall to your employee and they say no, you are not penalized for that as long as you have the proper documentation to support that happened.
Hey, Sam, one of the things I'm taking a look through some of the chat that's coming through here too, and I want to highlight the point of the Raymond resource page right here and the information that's there, but also note that we have done several webinars on some of these topics, podcasts, not webinars on these topics that you can listen to and learn a little bit more about the HHS stimulus and other things impacting healthcare providers as well. We're going to reply back to your comments too, and then probably most importantly is reaching out to your Raymond advisor to discuss these types of things with. At Raymond, we're a big team. They will often reach out to one another to find your answers. So please make contact with your Raymond advisor to go over any questions you have.
That's a great point, Don. We are hoping to have additional content come out. So really quickly, before we do wrap up, we do have a polling question. If you're interested in hearing additional resources, topics, we'd love to hear from you. So if you get a second in the last minute or two here, go ahead and cast some votes. Help us guide what you're hoping to see moving forward. So again, Don, Danielle, thank you so much. This is so beneficial. The recording, slides, everything will be made available following. We really appreciate your time today. This has been so valuable.
Thanks, everyone. We appreciate your feedback by answering this question.
Yep, thank you.